All right, thanks for joining me here in this video series where we will be discussing premium financed life insurance, or in some cases, you'll hear it be called bank leveraged life insurance. I'm Justin Martin with Legacy Wealth Management and Filament Insurance. Now, as a disclaimer up front, this strategy isn't for everyone. In most cases, you do have to be what's called a qualified investor to jump into this type of a strategy. So what's a qualified investor? Well, the definitions vary a little bit, but in most cases, you do need to have a net worth of $5 million or more to really consider jumping into this strategy. So purposes of this video series here is educational in purpose. I want to make sure you understand conceptually what this is, the risks involved. We'll take a look at a case study, but know that to really decide if this strategy is for you, call us up, schedule an appointment with us, let us know that you are interested, and we'll talk through suitability and really find out if this is a good strategy for you at this time. Okay, so let's jump into it. I'm going to pull up my tablet here so we can take a look as I visually demonstrate what's going on. Now, the overall product that is going to be used in this concept of premium financed life insurance is what we call a permanent life insurance policy. Now, in another video series that we did on cash value life insurance, you might recall that one of the big benefits, one of the reasons why we like permanent life insurance is because inside of that life insurance product is an equity position that we call cash value, okay? Cash value is what gives you your living benefits associated with life insurance. Now, let me be clear here. Life insurance is a death benefit vehicle, and that's always how it's going to be treated. However, this cash value life insurance contains these living benefits that we can utilize. And I'll just highlight them here briefly, but I will refer you to another video dealing with the living benefits associated with cash value life insurance, okay? So number one, cash value has a growth component associated with it. Now, depending on the product and how it's established, typically cash value will grow at 4 to 6% per year. On top of that, if this policy is structured correctly, okay, let me say that again. If the policy is structured correctly, then this policy can also be very tax advantaged and can be used in a tax-free way. Okay, this is dealing with the IRS tax code 7702. Okay, this cash value also contains a lot of creditor protection associated with it. Okay, and this policy can be used, the cash value can be used in the form of a withdrawal or what they call a policy loan provision. Okay, you can borrow against your life insurance policy. Okay, now here's what happens. So again, we've got those great living benefits associated with the policy. Now here's what's going to happen. Typically, when you take a look at creating a permanent life insurance policy, the way that it is presented to you is that agent or advisor, whomever's meeting with you, comes to you and says, all right, you're going to be setting up this life insurance policy and you're going to be making X amount of dollars in premium payments per year into that life insurance policy. You'll have this growing death benefit every year, and you'll have this growing cash value that you can use year by year since it is your equity within the policy. Okay, great. It's a great type of a structure. It's a great tax-free vehicle that you can be utilizing. And it's something that I use on myself, and a lot of my clients use it also. Okay, so for example, you could go out and borrow against this life insurance policy to go purchase a piece of real estate. And then when that real estate is cash flowing, turn around and use some of that cash flow to pay that policy loan back off. Okay, it's kind of this banking policy concept. Well, today what we're going to go over, let me just delete that out, is how do we really get this policy growing a lot quicker, a lot more effectively, and really take advantage of the velocity of money. Okay, premium finance life insurance or bank leveraged life insurance. Okay, so in my artistic way, I'm going to come over here and I'm going to draw a picture of our bank. Okay, here's what we're going to do. We're going to say, hey, bank, the client is setting up a cash value life insurance policy, and they're going to be making X amount of dollars of premium payments per year into that life insurance policy. Let's say you're putting in, let's say you're putting $100,000 per year into that life insurance policy. Well, instead, what if we went over to the bank and we said, bank, will you make the premium payments for the client? And instead, this client will send that $100,000 to you in the form of principal and interest on a bank note or on a bank loan. Bank's going to say, great, absolutely, let's do it. And then the bank is going to be the one that is making the premium payments for you. Okay, so let me come over here and erase out this line here. Okay, so now we have the bank that's making the premium payments, and you are servicing the interest and principal on that bank loan. So what happens? Well, if you're making a $100,000 interest and principal payment to a bank note, the bank's turning around and maybe they're turning around and putting $800,000 into the insurance policy. Okay, you've now been able to leverage your dollar in a very safe and effective way. Okay, the concept here is the same as if you were going to go and purchase real estate. If you were going to go purchase a single family home in your neighborhood, 3-bedroom, 2-bath as a rental property, you could pull together the $200,000, $300,000 to go out and purchase that home outright and have this cash flowing property. Or you could go to the bank and get a 30-year mortgage and use the bank's money to purchase that property for you and let that cash flowing property pay off that bank note for you, right? That way you'd keep cash in your pocket. We like to use the leveraging concept of the bank whenever we can, using other people's money, right? So that is what we are doing here. Now, this process of the bank making the premium payments for you, this process happens for 5 to 7 years, okay? So the premium payments go out, and then it builds that cash value. You're making the interest payments each year. After about a 5 to 7 to 10 year period, whatever the scenario is that we put together, at some point in time, we're going to come in and we're going to scoop out some of this cash value and we're going to pay off that bank loan. Okay, we're going to pay off that bank loan. So now the bank is no longer associated with this process, and you are left over with this jumbo life insurance policy that is completely paid up. Okay, no more premium payments are due. Nothing else is due with this policy. You've got this insurance policy that has this cash value that is continuing to grow, and that we're continually able to use these living benefits associated with the life insurance policy. Okay, so again, we just used a bank to make the premium payments for you. Now, why does the bank even do this? Well, the reason why the bank really likes to do this is it's a very, very safe loan for them. In the end, the bank will always get their money back because they're going to put a lien against the insurance policy. If you passed away and that bank note wasn't paid off, well, the death benefit's going to pay off that policy loan. Okay, so it's a fully collateralized type of loan. It's a secured loan. Okay, so it's a very safe place to be in. Now, in the next video, we're going to discuss some of the risks involved in premium life insurance. Okay, we've got a couple of moving targets here. Okay, interest rates are a big risk that we have here involved. So jump into the next video discussing the risks involved with premium finance life insurance. Okay, thanks for joining.